Billions of dollars disappear for no good reason. Smart tax planning. It is the crucial shield against this unnecessary loss. Most people do not realize just how much of their hard earned money goes straight to taxes. For many, it feels like a never ending battle, a confusing maze of rules and forms. Imagine working for 12 months and nearly a third of your paychecks are simply gone. That is what effective tax rates can feel like sometimes. The average American family might see 25 to 35% of its income vanish into federal, state, and local taxes combined. That is not just income tax either. We are talking about property taxes, sales taxes, capital gains taxes, and even inheritance taxes. Each one is a separate bite. The Internal Revenue Service tax code alone is a monstrous document, reportedly over 75,000 pages long when including all regulations. Nobody understands all of it, not even most tax professionals. This complexity creates huge opportunities for those who plan ahead. It also creates large pitfalls for those who do not. Many small business owners, for example, fail to utilize legitimate deductions, leading to higher taxable income and a much larger tax bill. One study showed that nearly 47% of small businesses overpay their taxes. They miss out on key deductions. This oversight costs them thousands of dollars each year. Think about a small startup making a net profit of $100,000. If they miss $20,000 in deductions, their taxable income remains $100,000. But if they correctly apply those deductions, their taxable income drops to $80,000 at a 25% tax rate. That is a $5,000 saving. That $5,000 could buy new equipment or hire an extra part-time employee. For an individual taxpayer, careful record keeping and understanding credits can make a significant difference. A family with 2 children might qualify for thousands of dollars in child tax credits if they are unaware that money stays with the government. Educational expenses, medical costs, even certain home improvements can offer tax breaks. It is not about avoiding taxes illegally. It is about paying exactly what you owe and not a single penny more. This requires foresight and usually begins well before the tax year ends. Many people wait until April 15th rolls around. That is often too late to implement effective strategies. Real planning starts in January and continues throughout the year. Quarterly estimated tax payments, for example, are essential for self-employed individuals. Missing these can result in penalties. Last year, over 9 million taxpayers received penalties for underpayment or late filing. Those penalties can add 5 to 20% to the original tax liability. That is extra money that vanishes from your pocket. Retirement accounts like a 401k or an individual retirement account IRA offer incredible tax advantages. Contributions to traditional accounts are often tax deductible, reducing your current taxable income. The money then grows tax deferred until retirement. For a person earning $70,000 a year, contributing $5,000 to a traditional IRA could reduce their taxable income to $65,000. This could save them hundreds of dollars in taxes. Right now, Roth IRAs offer tax-free withdrawals in retirement. This choice between traditional and Roth depends on individual circumstances. It is a decision that can save tens of thousands of dollars over a working lifetime. Investment choices also play a critical role. Holding investments for more than 1 year usually qualifies for lower long-term capital gains tax rates. Selling an asset after 11 months instead of 13 months could double your tax liability on that profit. Tax loss harvesting is another smart strategy. If you have investments that have lost value, selling them can offset capital gains or even a limited amount of ordinary income. This can reduce your overall tax burden for the year. This strategy alone can save an investor hundreds or thousands of dollars annually. The average tax preparer handles around 150 client returns each tax season. However, a dedicated tax planner or financial advisor goes much deeper. They work proactively throughout the year, not just during tax season. They help anticipate life changes, like marriage, a new child buying a home, or starting a business. Each of these events has significant tax implications. A financial advisor might charge a fee of $1,000 to $5,000 for comprehensive tax planning services. But the savings they uncover could easily exceed their fee by 2 or 3 times. For a high-income individual or a complex business, the return on investment for professional tax planning can be exponential. The tax landscape is constantly shifting, too. New laws are introduced every year. The Tax Cuts and Jobs Act of 2017 made sweeping changes. Staying informed is nearly impossible for the average person. This makes expert guidance even more valuable. For example, the standard deduction nearly doubled for many people under the 2017 Act. Knowing whether to itemize or take the standard deduction became a new calculation for millions. Some states also have their own unique tax laws. California, for instance, has one of the highest state income tax rates in the nation, reaching 13.3% for high earners. New York also has high state and local taxes. Moving from one state to another can profoundly impact one's tax situation. Even choosing where to incorporate a business can reduce state tax burdens significantly. Delaware is a popular choice for corporations due to its favorable tax laws. A business owner might save hundreds of thousands of dollars over years by choosing the right state. This is not about loopholes or shady dealings. It is about understanding the legitimate framework and optimizing your financial structure within it. Ignoring it is essentially leaving money on the table, money that could be invested, saved, or spent. Many people avoid thinking about taxes because it seems complicated or overwhelming. They might even fear an audit, but proper planning and meticulous record keeping actually reduce the risk of audit. The IRS uses data analytics to flag anomalies. Consistent and accurate reporting with supporting documentation is your best defense. The average audit rate for individual taxpayers is less than 1%. For those earning $1 million or more, it jumps to 2.3%. Still a very low chance. Ignoring tax planning does not make the problem go away. It often makes it worse. It is a fundamental component of financial literacy and personal wealth building. Every dollar saved in taxes is a dollar earned. It has the same impact on your net worth as earning another dollar of income. Maybe even more, because it is a dollar you keep immediately without further work. In fact, saving a dollar in taxes is often more valuable than earning an extra dollar of income, because the earned dollar would also be subject to taxes. This compounding effect over decades means that good tax planning in your 20s and 30s can lead to a significantly larger nest egg in your 60s. It can mean the difference between retiring comfortably or continuing to work longer than planned. It truly matters more than ever before.